Are we on? Hello, I'm Adam Child, President of Titan Capital Holdings. Thank you for joining us today on this live presentation. I'm here today to talk with you about Titan Capital Holdings, who we are, what we do, and our new Titan Capital Real Estate Fund investment opportunity. We've put together a PowerPoint presentation to accompany my narrative, so let's get started. Titan Capital Holdings is a private money lender and real estate investor in Arizona, Nevada, and in California. Titan Capital Holdings provides investors the opportunity to participate in the Titan Capital Real Estate Fund 1, which provides consistent above-average returns secured by real estate. Titan Capital Real Estate Fund 1 is actually our fourth fund and our fifth source of capital for Titan since the inception. But this is our newest fund and the one that we're most excited about. Titan Capital Real Estate Fund 1 is proud to provide a preferred interest to our investors at the annualized rate of 10% secured by first position deeds of trust. You know, our investors give me three responses to that. One is, it must be too good to be true. The other is, it's not enough. And the third is, that's fantastic. So you'll see as we get through this presentation how Titan operates, how Titan generates its returns, and how we're able to pay our investors 10%. It's not too high, it's not too low. It's based on our business model and how we operate. And it's what we provide our investors. Our investors' preferred interest is paid out on a monthly basis and can be reinvested or taken as monthly income. The history of Titan. Titan was formed in 2009 with its initial fund, which was designed to provide short-term bridge loans to investors buying foreclosed properties at public auction. We have a sister company called InfoClosure, which is now 15 years old, and helps investors pick up properties at public auction. In 2009, Rick Rickert, the owner of Titan, was fortunate enough to have an investor step up and write a $4 million check and get the first Titan fund started. That investor is still with us today. We're very thankful for that, and we've grown nicely since then. Titan has since expanded to provide short-term bridge and transitional financing to real estate investors buying properties that are REO or traditional resale transactions. Titan provides residential construction financing on pre-sold homes and other qualified projects. And we will acquire real estate that presents significant opportunities. The Titan Capital Real Estate Fund is primarily designed to be a short-term bridge loan fund. But because we're in this space, when we see investment opportunities, good buys on real estate, we will take advantage of them. Since 2009, Titan has made more than 355 loans. We've had just 5 defaults with no loss of investor principal. We're proud of our accomplishments. That's an industry low ratio, and again, one that we're very proud of. One of the reasons I feel that our default rate is so low is because our primary borrower is a short-term bridge loan type of a borrower. These are investors who are using our funds for convenience for short-term loans, 6, 12, and 24-month type bridge loans, which I'll get into more through the presentation. We feel that that contributes a lot to our low default rate. We have had just 3 foreclosures and 2 by way of deed in lieu. So since 2009, our investors have always gotten paid the 1st of every month, and I should clarify, investor checks go out about the 5th of every month, and not one month have we missed an investor distribution, and we have not lost a dime of investor principal. And we have investors who come in with capital, they make a cash call, take some capital out, and then typically come back in. So we're very proud of our track record. Titan is currently at $10 million under management. As I mentioned, we started in 2009 with $4 million from one investor. We've grown to $10 million. I'm going to get into the demand for our product and why we're reaching out to you, the investor, to raise additional capital for Titan. The vision. Titan has an immediate goal to grow to $50 million under management in the markets of Arizona, Nevada, and California. That might seem like a big number, but it's not relative to the demand that's out there. When you're talking about Arizona, Nevada, and Southern California, and some of my history in terms of originating, producing loans for 24 years now, that's not a big number. It's based on the demand that we see come through here on a regular basis and have for the last couple of years. This projection is based on the ongoing deal flow and additional market penetration in the marketplaces we serve as our capital platform grows. Okay. The need for short-term bridge financing for real estate investors and builders is significant. Titan's business model plans to take advantage of these opportunities. Have any of you tried to get a bank loan recently for a short-term bridge-type financing on real estate? Again, I've been in this space since 1989, and bank financing is very, very difficult to obtain. I transitioned into private money lending in 2010 when I met Rick, and it was my belief then, and it's even more so now, that given the shakeup in the real estate lending environment, the need for our capital for these types of projects is even more now than it's been in the past. The executive team. Rick Rickard is the founder and CEO of the Titan Companies. Rick's a veteran real estate investor of the past 15 plus years, has been involved in more than 2,000 real estate transactions. Rick is also a licensed associate real estate broker in Arizona. So again, over 15 years involved in this space, more than 2,000 real estate transactions. We're not reaching out to the investors with a new business or a new idea. Rick is a veteran and a pro, and I am a veteran and a pro as well. So Adam Child, as I introduced myself, president of the company since I joined Rick in late 2010. I am a veteran real estate lender, originator, and underwriter of the past 24 plus years. I started in the loan origination business in 1989 here in Arizona. I can't believe it's been 24 years, but I guess it has been. Myself and my teams have been involved in more than 5,000 loan transactions. In a normal market environment, it was very common for us to originate and fund between 10 and 25 million a month on a regular basis. So you take the demand for private short-term bridge financing that exists today, 50 million under management to fund some of the best projects we can find on short-term bridge financing is not a big, undaunting project. We have more than $1 million a week in deal flow right now that surpasses what we're able to fund currently. I am also a licensed mortgage loan originator in Arizona and have been in that space, as I mentioned, since 1989. Who is our team? I'm very proud of the team we've assembled in the last couple of years. Ashley Child is my oldest daughter. She's a graduate of Arizona State University. She has been with Rick and myself here for 2.5 years now. She is a licensed Arizona originator. Glenn Michaels is our vice president here and in charge of consumer and portfolio lending. Glenn came to us by way of Flagstar Bank. And again, he's a veteran broker and a veteran banker and very well versed in the loan origination side of the business. And Glenn is a licensed Arizona originator. Cole Strebel is our branch manager and our licensed originator in Nevada. Cole came to us about a year ago by way of Wells Fargo Private Client Services. So you get the impression already our team is very strong and comes from excellent backgrounds. Chip Seacon is our California DRE licensed broker. Chip has been a broker for more than half a dozen years now and a licensed appraiser since 2004. Chip helps us with all of our due diligence and our deployment in Southern California. He's a true pro and a veteran as well. We're very proud to have him on board. Lisa Karcher comes to us by way of Pacific Coast Mortgage and First National Bank of Layton, Utah. Lisa has more than 10 years in the loan origination and processing and underwriting side of the business. She too is a pro, and we're very happy to have her on board. Nikki Wooldridge is our controller. She's been our controller here at the companies for several years now. Nikki is responsible for implementing the mortgage office software, which we are implementing right now. The mortgage office software takes every aspect of our business and consolidates it into one format of accounting, billing, loan docs, investor management of investor funds. It's a very comprehensive program. We're actually investing $40,000 in this software program. It is a program that takes the quality of our management of operations financially and everything else to the next level, to the highest level you can possibly be at. From an investor standpoint, what it allows you, the investor, to do is literally log into the site and go and monitor your investment at any point in time. You can monitor what your investment balance is, what your year-to-date earnings are, where your dollars are deployed, how much of your dollars are sitting in cash. It gives you a picture very similar to what you might find if you have a Smith Barney or a Charles Schwab type of an investment account. We're very excited to be rolling this out. Mark Windsor and Michael Tafoya are our legal team. Michael Tafoya also being our trustee. And Mitch Medgovich is our compliance advisor. I can't say enough about Mitch Medgovich. Mitch is a 30-year veteran of private money lending here in Arizona. Mitch had a company called Cattleman's Mortgage, which he just recently closed down and retired. But Mitch has been an advisor to us for over a year and a half now. Mitch has just been great. He keeps us up to date on all of our loan documents, all of our compliance items. If we have any question about any compliance-related items, he's a phone call away. We make sure that everything we do adheres to all of the lending requirements in Arizona, Nevada, and in California. Again, Mitch being a 30-year veteran, he is a trusted consultant and advisor to us. He is one of a few people that I've known for over 20 years who also weathered the storm. He got through the crash in 2006, 2007, 2008, and managed his investors very successfully, even though it was hard for most people to get through that period of time and not take a little bit of a hit. Mitch did a great job with his investors, many of whom have joined us over here at Titan now as well. Our team, as I mentioned at the beginning, I'm very proud of the team we put together. They're all hard workers, quality people, and really make it possible for us to be at this platform and ready to grow to the next level. Our offices. For over a year now, our corporate office is in 10,000 square feet, occupying the second floor of the Bank of America building here in Mesa, Arizona. We've got a fantastic space here, and it's a lot of room for our team and a lot of room to grow. Very professional office that we're, again, very proud of. This live streaming is coming to you from our training room here in our office, in our corporate office in Mesa, Arizona, and we welcome all of our investors to come by anytime to visit with us or to sit through one of our presentations and to just learn more about what we're doing over here. We also have our office, which is a physical office that we do maintain in the old downtown part of Las Vegas, Nevada, near where all the auctions take place for foreclosed on properties. What's our product? As I mentioned early on, we pay our investors 10%. The reason we can and do pay our investors 10% is a function of how we lend out our dollars and generate income on our dollars, which I'll talk about right here. We have three primary loan products: 6-month, 12-month, 24-month, short-term bridge transitional loan products. And then our fourth product, which is picking up more and more popularity now, is our construction loan product. Back in the mid to late 90s, I did a significant amount of construction loans, so this is not a loan product that's new to us that we're trying to figure out. Again, I've been doing this for 24 years and have literally done over 300 construction loans at this point in time. In the mid to late 90s, I was one of the top construction brokers with National Bank of Arizona. So we're very well poised to handle the construction loans, manage them, and as inventories drop down and the market stabilizes and the economy comes back, we see the demand for construction loans starting to pick up more. Our dominant product, however, is the 6- and 12-month short-term bridge financing. And you'll see that we do, our rates on the 6-month are at 16 and 18%. So quite simply, we pay our investors 10, and we live off the margin. It's that simple. Our 12-month term is rates 14 to 16% plus points and fees. The longer we'll go, the more the rates will come down, and we will have additional points and fees on that. That's usually a loan that might require more underwriting, more due diligence up front. At 14 to 16%, we might have points of 2 to 4 points on there. And again, so we're paying our investors the 10%, and we're living off the margins and the fees. That's our revenue to Titan. The 24-month term is 12 to 14%, again, plus points and fees. And the construction loans we do are 12 to 15%, plus points and fees. And the range there really varies depending on the loan size and the amount of due diligence and upfront work that we have to do to establish that loan. That's what really varies that pricing structure. So it's a case-by-case situation. But if you understand that part of our business, you understand how we pay our investors the 10%. We lend. Our borrowers pay us the first of every month. They've got a 5-day window there. They're late on the 6th, which is why on the 5th of the month our investors get paid. We've not missed an investor payment, and it's our philosophy here, both mine and Rick, our investors get paid first, and that's how we operate. The demand for our product. The demand is significant, which is why we've opened up our 4th fund here, the Titan Capital Real Estate Fund 1, which again we're very proud of. We had an excellent team help us put this together. Leonard Rosen, a veteran fund producer out of Southern California, and John Hornick, our attorney on this fund, out of Freehold, New Jersey, if I can say that right. But this is our 4th fund and the one we're most proud of. It's the most comprehensive, and we think it's our best fund yet. Structurally, we think we put it together the best out of all of them so far. The demand, Titan receives more than $1 million per week in qualified loan requests that fit our conservative underwriting guidelines. We're not over here just trying to throw dollars out the door. Again, I'm 24 years in the space of doing this. The demand exists because I've been in this market. Rick has been in this market. We have a long list of established investors who borrow our money, real estate agents who know we have this product, investors who know we have this product, and the word gets out. And so we get a lot of good quality, regular demand that comes through here on a regular basis. Our goal to grow is simply to fill that demand. And like any other business professionals, we want to grow our business. So to do that in today's environment, we're reaching out to you, the investor, to help us raise capital so that we can continue to grow our business and continue to meet the demand for our funds. Demand right now primarily comes from past and current clients and referrals. You know, I mentioned earlier that I'm 24 years and over 5,000 transactions, and I never advertise. It was all done based on networking and referral. And one happy customer leads to usually 2 or 3 more happy customers, as we all know. And again, between my connections and Rick's connections, we've got inquiries for our loan product every single day. We don't accept every one of them. We don't approve every one of them. Some of the people that come in don't want to borrow our money after they learn about the pricing and the terms. But we're very selective in how we do that. Our current loan tape has an effective loan to value right now of 55%. That's pretty low. So you can make one loan on one note on one property, and we have many very good note investors. We really appreciate their support, and we really appreciate them supporting us by funding our notes individually. That's separate from our 4 funds. But if you fund one note, you carry the risk of that one note. We like the fund because the fund might have a dozen or more, 20 or 30 notes and properties in that fund, so the risk is diversified. There might be one at 70%, another one at 40%. As I say, our effective tape right now is at 55% loan to value. It's not uncommon for us to have borrowers come in. We had a gentleman a couple weeks ago pick up a property at auction for $240,000 and was going to maybe only need about $40,000 of our money. It's not uncommon. We had another gentleman pick up a property for $100,000 and only needed $60,000 of our money. That's at their direction. So again, we have many of our borrowers are conservative. They don't want to pay more than they need to for the leverage. We also possess a database of over 30,000 active real estate agents who we network with on a regular basis, and over 40,000 active real estate investors. These are people that we reach out to, and maybe some of you watching right now as part of that group that we reach out to, and we invite you to events like this or some of our events teaching Hard Money Made Easy, how to borrow our private money, that kind of thing. So, but we have a significant base to reach out to, which increases our deal flow quite a bit. Titan provides education, direction, and guidance on how to benefit from using private money loans through training and seminars at our offices just like this. Just before I started speaking with you today, Glenn Michaels was in here, and we had approximately 20 people that were all here to learn about our private money loan programs and our alternative loan programs and how to borrow the money. That's a pretty big deal. But we feel that education is key to getting the right kind of borrowers coming in the door, and to make sure that they know about us and how we operate and how to borrow our money and the responsibilities that go along with borrowing our money. Titan has become a preferred money lender in its marketplaces. Where we lend and invest. Titan focuses primarily on the metropolitan areas of Phoenix, Tucson, Flagstaff, Las Vegas, and this says soon Los Angeles and San Diego counties. Thanks to Chip, we are in Southern California now, so that's no longer soon. We're in Southern California now. Titan will not typically take on loans in remote or outer-lying areas. Somebody asked me the other day at another event that we did about mortgage insurance. Well, obviously, as a private money lender, we don't have mortgage insurance for our protection. That's why we require the equity position of 30% or more from our borrowers, so that if there's a default, we've got some room to work with there to get the property back and get the capital back where it needs to be and hopefully not lose any money. Defaults are real. They happen. You know, our track record is excellent, but defaults are real. They happen. We try to make decisions to minimize that. I've been asked to do loans in the remote parts of the state, and I've taken passes on them. I've been asked to do loans in the remote parts of Nevada. I've taken passes on them. And the reason is if there's a default or for some reason we end up with that product back, we want to make sure we've got the best opportunity to market it and sell it quickly. Underwriting. Whether we do a loan for an investor or an owner-occupied or second home, we use a standard Uniform 1003 residential loan application. Now let me clarify, though, that investors who invest in the Titan Capital Real Estate Fund, this fund is only for short-term investor bridge loans. We do not use these dollars for any owner-occupied or second home transactions, so there are no Dodd-Frank, RESPA, Safe Harbor issues that will ever interfere with the loans that we make or the investments that we make from this fund. But we do have a very standardized loan application process. Loans are processed using the Calyx Point software I've been using for over 15 years myself. Titan looks heavily at the following 4 criteria. Again, we're a private money short-term bridge lender, and our objective is to always make sure we protect the investor dollars. So, item number 1, the collateral. What type of asset is it? Is it a decent asset? Is it fairly valued in its neighborhood, in its area? Is it an asset that if we have to take it back, how much work does it take to get the asset turned around? Or is it a good quality asset? We just recently funded a residential home loan on the Gilbert Lakes area over here. Home was worth over $550,000, and our loan was a little over $300,000. But a quality home, very nicely done on the lakes. We do that all the way to a loan we're getting ready to fund right now, where the home, just to move into it and live in it, needs about $10,000 worth of rehab before it can be moved into. So in that situation, not only are we taking the down payment, but we're taking the borrower's rehab dollars and we're holding them in escrow to make sure those dollars go to fixing up that home so that we're sure that that home gets to its best finished value. The borrower's capacity, their equity and their ability to pay. If they don't have the down payment and the equity, we're just not interested. Now, we're typically looking at a minimum of 20% down on cost and at least 30% equity. So if 20% down doesn't also show us more than 30% equity, then what are we going to do? We're simply asking for more money down. Okay? So we look for the equity. We look for the borrower having skin in the game. We have not funded a loan yet where there's not been a borrower with skin in the game. We just won't do it. And the borrower's ability to pay. What are their resources? What's their income? What's their cash after the purchase? Do they have the ability to service the debt, to fix up the home? We look at that. The credit. Credit risk is assessed. We are not credit score driven at all. However, we do look at credit, and as I say, we look for a train wreck. And here's what a train wreck is. If a borrower has significant tax liens, judgments, they're in the middle of a bankruptcy, maybe in the middle of a foreclosure, or if they're simply a habitual late payer, that's what we're going to take a pass on. Those are situations that we don't want to get involved in. We had a borrower come through here several months ago who had about a 550 credit score, but had been on her job for 21 years and had lived in her home for 19 years and was buying an investment property to rent to her son. Well, the only issue on her credit report that was causing that score was about a year and a half of trying to restructure her FHA loan on her primary residence. The rest of her credit was perfect. So I do not believe you can be credit score driven. You have to evaluate credit for what it is. Does it pose a risk? And that's what we look at. We do see some credit reports come through here, and the borrowers are clearly habitually late borrowers. We take a pass, because why do we think our debt's going to be any different? And the exit strategy. Again, we're 6, 12, 24 months, and construction loans that are typically pre-sold, although we are starting to look at some specs in the right areas, the right marketplace with the right borrower. Those are short-term transitional loans. What's the exit? Well, our dominant borrower is still a fix and flip borrower. But we also have a lot of our borrowers who are in today's market, they're buying, fixing, and renting because we're back into an appreciating market, and then they're going to go ahead and put a tenant in there and wait for another year for it to appreciate more, and then maybe they'll sell it at that time. Or they'll buy it, clean it up, put a renter in there, and then take us out with longer-term conventional financing. But we always know what the exit strategy is. As I shared earlier, we require a minimum 20% down on cost and a minimum 30% equity position. Also, as I shared earlier, taking into account those minimum requirements, our current loan tape is at 55%. The valuation. In determining property values, Titan utilizes the following valuation methods. We use the 3 typical valuation methods. We use a CMA, which is a comparative market analysis. Basically, we have our real estate company here and our designated broker, and we go right into MLS and we pull comps. Okay? And when I evaluate a property's value, I'm not looking for a BPO or an appraiser or somebody to tell me, kind of a consolidated estimated value. I look specifically at model match comps. I don't want to know what's listed. I want to know what's sold. I want to know what's like the subject property that we're looking at. So a CMA, a comparative market analysis, if it's used properly, can be very, very effective. And so far, I think we've been very successful with it. We also have a very good company we use for BPOs, broker price opinions. And they cover us in Arizona, Nevada, and California. If I get a CMA, I will almost always also get a BPO. Now, I'll do a CMA and a BPO in tandem on most of our short-term loans. In other words, the loans that we fund very quickly. Somebody buying at auction today needs to be paid for tomorrow. We don't have time for a 3 to 5 or 7 day appraisal. So we use the CMA and the BPO to get quick valuations. If somebody's coming to us on a longer-term transaction and it's a purchase transaction, closes in a couple of weeks, we'll start with the CMA. We'll see what kind of comps we can pull internally to value it. If we're not comfortable with that, we'll also reach out and get a full appraisal. So almost every one of our loan files has at least 2 of these valuation methods in it. Risks. I mentioned 2 things earlier, and I want to talk about it here for just a minute. Our track record has been excellent, but I would never want to portray or pretend to you, the investor, that an investment here doesn't come without risks. But so does an investment in a stock. So does an investment in you going out and buying a piece of real estate yourself or investing in some other businesses. We all know as investors that investments come with risk, okay? But we feel that we've structured ourselves to really minimize that risk. I'd like to think we've taken the risk out of it altogether, but the reality is there's some risks. Well, we're primarily a short-term bridge lender, so what are the risks? Well, the market can collapse. We just went through that, saw one of the worst real estate market collapses in about 100 years. I don't think any of us saw that much of a correction coming. I was predicting 15 to 25%. I don't think any of us expected a 50 to 60% slash in values, but we went through it. The good news is for where we sit right now is we've gone through that. Now, do you think it's going to happen in another year or two? I don't. Is it possible that it can happen in the future? Sure. But we continue to watch the market and try to make our loans based upon what's going on in the marketplace and not get crazy. None of this 100% financing stuff, none of these loans where the investors are not coming in with skin in the game. You know, we do things to mitigate our risks. But we make loans on real estate, so what can happen? The borrower doesn't pay. We have you're late after 5 days, so on the 6th day there's a late charge, and on the 31st day there's a default rate of 29%, and we start foreclosure. So if the borrower doesn't pay, there's a loss of income while the borrower is not paying. If we have to foreclose, there's the cost associated with foreclosure. But we've been through that. We know the process. If we have to do that, we could have an asset in the pool that doesn't perform for 120 days. But when we sell that asset, if it's been properly underwritten and lent against, and we sell it at auction, at that time we recoup the principal, the legal fees, all the interest, plus the late charges, plus the default. Okay? So, but while we're going through that process, there is a risk of loss of income on that. It's simply from the borrower not paying. And the borrower not paying might be intentional, or it could be a situation that's beyond their control. One of the deed and lieu's we took back was a father-son team, and the son had an opportunity to go take a job up in the Northwest, and after 6 transactions with us, left his dad with the last one. And the dad realized he's in over his head, came to us and handed over the deed and lieu. We took on the property, finished it off, and sold it for, it's a home that I want to say we listed around $199, sold for $215 in the old downtown Phoenix area, popular neighborhood, I guess. I don't think we knew it was that popular. But the 2 primary things are loss of income, as I just talked to, and then loss of principal. Now, the practical side of what I'd ask you to evaluate is, okay, we make a $70,000 loan on a $100,000 piece of property, and the market crashes. Now, let's say the market crashes another 50% like it did a few years ago. So that $100,000 home is now worth $50,000, and we've got a $70,000 loan against it. Did you lose all your capital? Did we lose all the capital? We did not. We took a $20,000 hit on that asset. That's a worst case scenario. If our effective loan tape is at 55 or even 60 or even 65%, we have to go through a market correction on our loan tape of 40% or more just to get to a break even with our capital under management. Okay? And does that make sense? So I'm sure it does. But loss of income and loss of principal. Loss of income, borrower not paying. Loss of principal, market correction or crash. A dollar doesn't leave here without us making sure that we have full title insurance and also hazard insurance is in place. We had a situation recently. Nice young kid got a property at auction. A couple weeks into the project, plumber was out there, torched one part of the house. Half the house burnt down. Well, we're listed as additional insured all the time. The insurance check came to us, and we regulated the renovation of that home, making sure our asset was always protected. And the borrower successfully sold the home and did very well. Some of this is repetitive to what I've said. Note our current loan portfolio is 55% loan to value, which remains extremely conservative in our industry locally and nationally. Many of our borrowers put down more than the minimum required to reduce their cost of leverage, as I mentioned earlier. Security. What's the security? I think our security here is really good. When you invest in a stock, you hold the stock certificate, okay? But you do not hold any control or security in that company if the company were to go to zero, okay? The security here is when we make a loan, Titan Capital Holdings is the originator that makes the loan. The Titan Capital Real Estate Fund is the fund that provides the capital for the loan. Titan Capital Holdings then assigns that asset back to the fund. Okay? So the dollars used from the fund are collateralized by the asset that the loan was made against. Or if it's an asset that we purchased, that asset goes into the fund until we finish rehabbing it and selling it. Okay? First position, deed of trust. we do a first position deed of trust on every asset, obviously. Promissory note, title insured. We do not send a dollar out of here, as I mentioned a minute ago, without being title insured. Cross collateral when appropriate. It's not uncommon for us to do loans, maybe 2 or 3 loans for one borrower. If we get into a situation where I think maybe we're doing too many loans for a borrower, I shouldn't say too many loans, but let's say we're in a situation where maybe we're now doing 2 or 3 loans for a borrower. I will typically take an additional deed of trust and cross-collateralize it over the assets, just to make sure that we're fully protected. I have several cross-collateral agreements in place now. It's what we do to make sure we're protected. Hazard insurance, I just told you the story about that. Everything's insured before a dollar leaves here. The whole team knows about it. Nothing gets funded without hazard insurance in place, with Titan listed as additional insured. On our short-term loans, 6 and 12 months, we do not do impounds. However, we make sure the hazard insurance is paid up for the term of the loan and the taxes are current. If we go 12 months or longer, we do impounds for taxes and insurance. That's the security aspect of what we do here. Disclosure. You're watching this right now as a potential investor in the fund or investor at Titan. What do we provide our investors? Well, we provide you a complete copy of the offering, which spells out everything that we do and a lot of what I'm telling you right now. You've got the offering, and then within here is also the operating agreement, which tells you structurally how we operate, and the subscription agreement, which is what you, the investor, completes to give us information on you, and that's where we set up, how much you're putting into the fund, how we pay you, is it monthly, is it reinvested, that sort of thing. This fund also has quarterly reviewed financial statements. Now, if you don't know what a quarterly reviewed financial statement is, it's a statement provided by our CPA, and it's just one step down from an audited. It's quarterly reviewed. It goes out to each investor. We do an annual audited statement on the fund that also goes out to each investor. And actually, our financial statements are done monthly, so our investors in the fund, as with all of our funds, when the checks go out each month to the investor gets a copy of the balance sheet. So if you invest in this fund, you'll get a monthly balance sheet that goes out with your check so you see where it stands, but then you'll also get quarterly reviewed financial statements and annual audited financial statements. That's the best we could come up with to try to be as transparent and accountable as we could be for our investors. Without you, our investors, we don't have the capital to grow and build our business and do what we want to do, which is simply build our business, build it with good quality investors, pay our investors a good return, and build our business and do what we've been doing and want to continue to do. We like what we're doing, and we want you, the investors, to join us. Why Titan? Well, the team. Again, this is not our first rodeo, okay? Rick's been around, I've been around, our team has been around. I mean, this is not people that are new to this business. We've been around. The last couple of years we've been here building a fantastic platform for Titan to grow on. And again, I'm very proud of it. The experience, I've spoken to that. The marketplace. We all know that the real estate market's starting to come back a little bit. It's not going crazy because we don't have a real strong economy backing it up. But we can all arguably say that the real estate market's probably hit the bottom. It might have some bumps along the way, but I think overall we can expect to see real estate values continue to go up. I hope not crazy. I hope they don't go crazy up any more than probably you do. We just want a good, normal, healthy real estate marketplace that we can participate in, which went on for quite a while until we had our latest collapse. But the marketplaces that we're in, Arizona, Nevada, California, good, active, robust marketplaces as they exist here in the United States. We all know that this southwest area continues to be a good, robust market for real estate. The security, I talked to you about what we do to provide security to our investors in the fund. The return on investment. I'm an ASU graduate student of finance. I don't know, but I know there's opportunities to make more, and I know there's opportunities to make less. The return on our investment is good. It's good and it's consistent, and it fits our business model. I know there's returns that are higher. I know there's returns that are a lot lower. just look at our return as our return fits our business model. There's other things everybody can get involved in. As I say, pay more, pay less, have absolute guaranteed security, government bonds, things like that. All of that risk-reward varies. But our return is a consistent monthly return that's reasonable for our business model and pays our investors very well. Again, we're very proud of it. Our track record, very proud of our track record. Are we perfect? No. Are we going to have losses? Probably. I would never sit here and tell you we're not going to have a loss. But our objective in the fund is to put together enough investors, as we've done already up to this point in time, to diversify risk. That minimizes the exposure for loss. It's just that simple. The support system. Again, everything from Calyx point processing and underwriting software to the mortgage office, administrative accounting and bookkeeping software, which is just phenomenal. For any of you that come on board, I look forward to showing you that part of our business. Very, very impressive. The qualifying process, again, we don't just throw dollars out to anybody that comes in the door. Let me be real clear about something. We don't want to foreclose. We don't want to take a property back. It's real laborious to foreclose and take a property back. If you haven't been through it, it's laborious. Forget that you're not collecting your income during that time. It takes you away from the good quality part of the business that you get to do day in and day out. So believe me, we look at the loans that we issue and we evaluate them and say, is this going to present a foreclosure risk? Yes, we can get the asset back. Yes, we can recoup all of our dollars and the interest and the default interest rate. We get all of our money back, the trustee, the foreclosure fees, and everything. But I'm a big believer in opportunity costs. And the time and the energy that goes into managing that process takes you away from other more productive projects. So what does all that mean? We want to be careful when we lend. We're a private money, short-term bridge lender. We're extremely flexible relative to the banks, but we look at the practical things. The borrower, the asset, the equity, that's it. You know, we look at the real practical things, and then we look at it and say, if this is an asset that's going to potentially give us a problem, we don't want to do it. It's just that simple. There's companies like ours that are referred to as loan-to-own. We're not loan-to-own. As I tell my investors and my borrowers all the time, I'm a veteran lender. I like to make loans, get paid, pay our investors, get paid off, and do it again. It's that simple. And we have a lot of fun doing it. Is it perfect? It's not perfect. We're doing pretty well. But, you know, sometimes something can go wrong. But our track record right now is excellent. And we like the way the marketplace looks ahead of us right now. Fortunately, I think we've got a good 10-year run before we see any kind of significant correction. 5 years for sure, and then it's just going to be a function of the economy and how things are going. So the qualifying process and the criteria, that's why Titan. And number one reason on Titan is the team. You know, there's places to put your capital. There's other places to invest. There's no doubt about it. We all have investment opportunities in front of us every single day. Who we are, the team, and what we do is simply why you invest here. We have personal relationships with every one of our investors. We appreciate every one of our investors. Without our investors, we're not in business, and without our investors, we cannot grow. So that's why we reach out to you, the investors, to do that. I want to talk a little bit about the mechanics of the fund. What is the fund? Okay, and I'm near the wrap-up, so I've gone a little bit longer than I expected, so please hang with me here for just a few minutes, and I'll wrap this up. Thank you for being on today. I'm just going to walk you through what this is. What's the Titan Capital Real Estate Fund 1? It's a Securities and Exchange Commission registered, so SEC registered, Reg D, or Regulation D, 506C, private equity offering. So those first four things, that's all the lingo. SEC registered, Reg D, 506C, private equity offering. Excuse me, I had lunch right before the presentation, so I'm a little dry. When you invest in the fund, I already talked about the disclosure items that you receive, but each investor receives a membership interest, which is equivalent to a share of stock. I had one of our investors ask me, what's the difference between a membership and a share of stock? They're really the same, but when you have an LLC equity fund, your interest is issued in the form of a membership. When you have a corporation, then your interest is issued in the form of a stock. Otherwise, they function the same. So as I point out here, membership interest goes with an LLC. Stock shares go with a corporation. A membership interest is in $10,000 increments. Okay? So if you invest $100,000, you get 10 membership interests in the fund. It does come with voting rights and membership rights in the fund. It's all spelled out in here. You have membership interests in the fund just as you do when you buy stock for a publicly traded corporation. Functions the same. The investment in the fund is for 12-month terms. We ask for a minimum 12-month commitment. We like it for longer than that, but we realize our investors have a need for liquidity. Really, we've told every one of our investors in all of our funds, if you have a need for a cash call, just try to give us 60 days notice. Because we make short-term loans, we're always making loans and getting paid off, making loans and getting paid off. We had one investor a couple of months ago needed $100,000 out of the fund, out of one of the funds. We were able to give her the $100,000 within, it was less than 45 days. And within a couple of months after that, she came back and brought back almost twice as much to put back in the fund. So she was able to take care of her need, and the end result was she came back and put more in, which we were happy about. We didn't know that that was happening. But it's liquid to the extent of the rotation within the fund. But again, keep in mind what our business model is. We make 6, 12, 24-month loans. So if the capital's in, we want it out deployed and working. You have a cash call, not a problem. Make a cash call, give us some notice. As payoffs come in, then we can get you back your cash or a portion of it, and that's just how we operate. But we really look for our investors to think long-term with us. You know, we're on at least a 10-year plan here right now. But even if this is a place for you for a year, great. If it's a place for you for 5 years, great. If you come here with the idea of being here a year and you need some of your capital back in 6 months, we'll work with you. We're here to work with our investors just like our investors work with us. That's a little bit about the fund. A membership interest comes with a membership certificate. Again, just like a stock certificate, $10,000 increments per interest. So again, $100,000, 10 shares. Rick and I are starting the fund off with $500,000 of our money. Okay, so 50 membership interest. That's how we're starting the fund off, with our money. We have skin in the game on this fund. How do you get started? How do you initiate your investment? You call us here at the office, call me direct, call Rick direct, visit our website, get more information. Basically, here's the process. Come visit with me or call me or email me. I can visit with you, go through the offering. We execute the operating agreement. You execute the subscription agreement. We provide you with the wiring instructions to the escrow account maintained by our attorney. You wire the funds in, and your investment gets started. It's really that simple. Your certificate is issued to you for the shares that membership interest that you obtain, and we're off and running. You start getting your monthly financial statement with your monthly check, your quarterly reviewed, your annual audited, and you know, I'll wrap it up this way right now. As I mentioned, we've grown from $4 million to $10 million in the last couple of years. We've got great investors on board. I really enjoy working with every single one of them. We're reaching out right now. We really think we've come up with a great structure to our new fund. We'd really like to see all of our funds roll into this fund at some point in time. And we've got a great vehicle for investors to invest in, get returns, and become part of our family here.